You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, last week, Mark and I took a little time out to answer some listener questions, and I do mean a little bit of time out because we are back into the strategies this week, and we've had some volatile markets. Once again, we got the volatility index spiking up. Today was actually a fairly big update, basically from promises of more stimulus out of Congress. And so far, all we've really heard are promises, but for some reason, the marketplace must have thought that this time around, they aren't kidding and that the market is actually going to bring in some more stimulus, or the Congress, I should say. So the Dow Jones Industrial Average finished up 424 on the day. SPX was up about 44. We saw the VIX go down, but once again, it just big up days. We see the VIX just kind of meander to the downside, and the VIX today is at 2134, down 177. So I am actually going to piggyback off of what we talked about on the Ally Invest YouTube channel this week. We talked about IWM, which is the ETF that tracks the Russell 2000 index, and we just talked about using long put spreads as a hedge against your small cap portfolio. Now, we build it that way, but also kind of talked about the fact that you could use it as speculation. And it's mainly because the IWM has actually been leading all the markets higher over the last couple of months. And today is also the case in that we see the IWM up 2.5% approximately, around $5.24. And we see the last trade on it was $227. Now, today we're going to be a little bit bearish, and like I said, we're going to steal that theme, but I'm going to look at it on a purely speculative basis, and I'm going to talk about what play inside the options playbook and how I would set it up as a speculative trade versus a trade that could be considered as a protective trade against your small cap portfolio in general. So as always on Options Playbook Radio, this is not meant to be a recommendation. We're just here to learn. And mainly, we just want to talk about, we have a situation where the Russell 2000 is definitely quite a bit higher than the 200-day moving average, the 50-day moving average. We saw the NASDAQ actually break down below its 50-day moving average this week for the first time since the beginning of November. So a strong bull market in the NASDAQ, but it's nothing compared to what the Russell 2000 has done over that same time period. So let's speculate on a trade. So how would we set this up? So the official paper trade for this week, or if you're looking it up inside the options playbook, would be a long put spread or a put debit spread, also known as a put vertical spread. And we're going to center it around where the underlying stock is trading. So thankfully enough, the Russell, or I should say the IWM, the ETF that tracks the Russell, was very kind to us and decided to stop trading right at a strike price. So in this instance, the last trade was $2.27.00, and that was up $5.24 on the day. What we're going to do is we're going to straddle that price. We're going to go 2 points in the money, and we're going to go 2 points out of the money. We're going to do a short-term trade. This is going to be very speculative. Today, like I mentioned, is Wednesday, the 24th. So we're going to look at March 5th. That means for this week, if you were able to execute it after the market closed, you'd have all day Thursday, all day Friday, and then the rest of next week in order to do this trade. And when I'm doing a long spread as a speculative trade, you got to really be cognizant of the expiration date that you choose, in that you'd like to have more time for the trade to actually play out. But when you're talking about volatile marketplaces like we have with the VIX at 2134 right now, and the IWM, these option contracts are trading right around 30% implied volatility, which is high since the pandemic. The markets in general have been highly volatile and high implied volatilities on the option contracts. When you're looking at doing a trade like this, you really need, if you're going to be correct on your forecast, for time decay to occur or implied volatilities to come down a little bit. So if I look at this trade that we're going to set up, like I said, 2 points in, 2 points out, we're straddling the actual stock price. That means we're going to look at the IWM March 5th, 229 strike put, and selling that same expiration 225 strike put. Now, because of the way a lot of index options, and the IWM is an ETF that tracks an index, work, there's usually a skewing towards out of the money put spreads compared to in the money option contracts. And that's just normally the case overall. So this is not an anomaly by any means. But that allows you, when you're doing long put spreads, to sometimes get them a little bit done cheaper as opposed to their counterpart. If we were looking at the same strikes, trying to be bullish on IWM and looked at buying the 225 and selling the 229 call long spread. So in this instance, the midpoint of this trade is $1.63. Okay, so I'm looking at this more as an all or nothing type trade, in that I'm willing to risk that $1.63 or $163 plus commission for every 1-by-1 spread that we do. We are straddling the marketplace, and we are able to get it done for less than $2. In theory, if this was a theoretical world that we traded in, this should be trading for about $2. So I feel like we're getting a little bit of a discount because of the skewing and volatility, and that if this was, as mentioned, a theoretical world, this should be trading for right around $2. And why, do you say? How do I know that? Well, it's because we're doing a 4-point wide spread. The underlying stock stopped right at the strike. So we're exactly 2 points in the money on the option we're buying and exactly 2 points out of the money on the one that we're selling. So normally when that's the case and it's a 50-50 bet like that, you're going to bet $2 to potentially sell it for $4. And the odds are going to be about the same on the upside and on the downside. So I kind of like this trade in that just because of the way the options are priced, just because of this little skewing that we're having in the Russell 2000 index. So we can get this done for $1.63 or $163 plus commission. And if we do that, then we get a little bit more upside than we have downside. So if you take 4 minus $1.63, that means we have $2.37 worth of upside. And that's good numbers overall, in that it's a 50-50 bet. If the stock goes down one, well, guess what? We should be up about one. And if the stock goes up one, well, then we should be down about one overall. Basically, if we look at the way this moves as expiration approaches, it's going to be very similar to the actual underlying, because we're straddling the stock and it happens to be right on a strike price. So we're going to give 10 days for this trade to play out. I ideally would like to just put it on and come back 10 days from now and see, did I make my $2.37 or did I lose my $1.63? Or did it land somewhere in between? And maybe I just made a little bit. I want to pay a little bit of attention to it overall, because one of the biggest things about ETFs that track indexes is that they do settle in stock. They're not cash settled. One of the benefits of trading index options is that if you came back and it did land in the middle, all that would really happen is that you would have cash in your account when it's a cash-based index. But in this instance, you'd have to be worried about what might happen with the stock. So you need to pay a little bit more attention when you're doing it in an ETF overall, especially one that will settle in stock. And as far as I know, all of them do. Okay, so with that said, let's recap what our outlook is. We've had a fairly big run up in the marketplace. Congress came out and said that stimulus is going to happen sooner rather than later, and it's going to be a good dollar amount. The market rallied on that news. The IWM is up a little bit. So we're just going to say that eventually there needs to be a little bit of a reversion back to the mean. How can we use options to try to set up a situation where we're managing our risk and giving ourselves a little bit more upside than we are downside in general? And one way that we can do that is by straddling the IWM or straddling the underlying stock and going a little bit in the money, a little bit out of the money, in particular when you have a volatility skew like we do right now in the IWM put options. So we're going to go out 10 days because there's still a lot of premium because of the volatility. As a matter of fact, I should probably mention the 229 strike put, the in the money put, is trading for, I'm going to go at midpoint prices, approximately $4.90. And the 225 strike put, the 10-day that's 2 points out of the money, is trading for right around $3.25. So that's still a lot of premium on a $225 underlying with only 10 days to go. So if you want to max out on that trade, ideally you want the market to go down below 225, and then you need that time decay to happen or implied volatilities to come in a little bit in order to get to that maximum. And the maximum that you could sell the spread for would be that $4. So overall, Russell 2000 index stopped trading at $227 exactly. We have the IWM March 5th 229 strike put. And at the same time, we're going to be selling the same expiration 225 strike put for a net debit of $163 to the account, or $163 plus commission for every 1-by-1 spread that we put on. Our upside potential is $2.37 or $237 less commissions if we were correct on our forecast. And at the expiration date, the underlying stock was below 225. Now, I want to mention to you that today, the 24th of February, we actually just finished our digital conference that we had. We had an all-day event, and you might feel that the tiredness in my voice because I was the host for the event, but I want to highlight the fact that you can rewatch it, that it will be available, all sessions, including my session on covered call writing, and all you need to do is go to ally.com/digital conference. Digital conference is all one word. So ally.com/digital conference. If you have any questions for me, please send them directly to me at theoptionsguy@invest.ally.com. Please follow me on Twitter. My handle is extremely simple, @BrianOverby. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Please follow me on Twitter. My handle is @BrianOverby. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.